Okay, so welcome everyone to the Q3 Carrington webinar. I'll be hosting the session today, and I'm joined by our Head of Investments, Mo, and our Director, Alistair. So today, the session, we will first review what has happened in markets over the last quarter, and then we will also move on to our outlook for the rest of the year, whilst touching on some key topics that have happened. And then finally, as it is VCT season at the moment, we'll be discussing our recent VCT offerings and the outlook within the VCT market. And then as a reminder, please feel free to post any questions in the chat as we go out through the session, and then we can address them at the end. So firstly, Q3 was quite a turbulent quarter than we've seen in the first half of the year. During a year of elections, wars, interest rate cutting, some volatility was expected. So despite all this, our portfolios performed well over the quarter. There was a bit of a market wobble at the start of August. Mo, it'd be great to hear your views on what happened during this and what caused this uncertainty we saw this.
Yeah, so good afternoon, everyone. Thank you very much for joining us today. So as Luke has just mentioned, it was a bit more of a volatile quarter, but thankfully positive across the board for all of our portfolios. I think there's probably 5 sort of key things worth mentioning of the quarter. That was right at the very beginning, the Bank of Japan and their slightly changed stance and messaging in terms of interest rate policy. So given that we have finally seen inflation in Japan for the first time in several decades, they have been talking about changing their interest rate policy to something that's a bit more normal, i.e. not zero. And so they had already raised interest rates and were talking about doing something more so. And that actually led to quite a material amount of volatility. The markets didn't particularly like it. And there are a lot of trades around the world that are attached to the very low rates of interest rates that we see in Japan. So early in the quarter, Japan actually had its worst day since 1987, where it fell more than 12% in one day. The second thing worth mentioning is that there were some concerns around US economic growth and whether that a recession would materialize. That was largely of some data points that came out around the labour markets. That again led to some volatility in markets slightly late, around sort of September time, but in a sort of similar theme across the quarter. The third bit was that the Federal Reserve finally cut interest rates after holding off for what felt like an eternity, and they cut by 0.5%. We'll come back to that in a second. The fourth is clearly a lot of tensions in the Middle East relating to the various conflicts going on out there, and the sort of increasing escalation, I think, is worth mentioning. So that had its role more towards the latter end of the quarter and the earlier parts. And the final bit, and certainly by no means least, the Chinese government came out with a very large stimulus package that surprised most people and led to substantial gains in markets that were exposed to Chinese companies. So all in all, quite a lot going on. The reason why I mentioned those 5 points is because they are likely to be with us for some time. Some maybe a couple of quarters, others perhaps several years. And so I think they will become an important, those factors will be important for our portfolios moving forwards. So yeah, just covering through these points. Obviously, this is the market volatility. There's a lot of talk about what sort of growth outcome we will see in the US, whether that would be a soft landing, which is something that's more palatable, or a hard landing, which is a more abrupt downturn in US growth. Most of the markets seem to be heading towards a sort of soft landing narrative, but there has been a bit of volatility around that, as some data points suggested otherwise. In terms of the portfolios, I think it was important in terms of what you didn't own, as well as what you did own through this quarter. So as I mentioned, the Japanese markets came under pressure as the Bank of Japan hinted at a more normalized policy. That's something that we've been sort of slightly nervous of for a while, as well as lots of optimism around Japan and lots of investors investing in Japan. And we saw that as perhaps a vulnerability in markets, and so have been working to try and reduce our exposure as much as possible. And then in a similar vein, we've also been reducing our exposure to US growth companies, so those that typically populate the NASDAQ. And you may have read about the Magnificent Seven, etc. So we've been trying to reduce our exposure to those, and that was largely because of excess optimism around the certain companies and the earnings that they were delivering or going to deliver. Normally, the way we operate is that we're absolutely fine with optimism, but when we start to see excess levels, that's usually the time when we begin to step back. And so we identify those particular markets as vulnerable to any stress. And that was pretty much what we saw in the earlier parts of the quarter, where when that stress point came, largely off the Bank of Japan, the Japanese markets fell the most, and US tech also fell quite heavily during that period. We saw another round of that in September, not as abrupt as it was earlier. But so since we've not really had much exposure to Japan, we've been reducing our NASDAQ-like exposure. The level that the amount we fell relative to our peer group was smaller, and therefore we navigated that slightly better than most. And then because we have had quite a reasonable allocation to Asia, and therefore by default China for some time, the large Chinese stimulus announcement that came right at the end of September led to a substantial rally in for example, the Hang Seng, that went up almost 30% in a very short space of time. That naturally benefited those funds that we have that are exposed to that market, and they too went up quite materially. So putting it all together, didn't really fall very much on a relative basis because of the areas that we had less exposure to, and then had a very good rally towards the end because of our overweight to Asia. So all in all the portfolio did very well on a relative basis, and that built on what has been a strong period of relative performance now for a couple of years. I suppose the one other bit worth mentioning is gold. So we've had gold for a long time in our portfolios where we can hold it. So there are some portfolios where we try to maintain only equities, the highest risk portfolio or the highest growth portfolio. However, in all our other portfolios, we do have physical gold, and we bought that back in 2019 when gold was around $1,300. Gold is now $26.50, I think, and Q3 was one of its best quarters of performance in about 8 years. So I think it went up about 12 or 13%. So again, that was a strong contributor to our return. So all in all, a very positive quarter. Maybe one last point worth mentioning is that we did begin to introduce certain government bond type exposures, particularly US Treasuries, and it was with the anticipation of interest rate cuts coming through at some point. Obviously, that happened a lot later than we expected, But finally, it did come through. Now, what typically happens in markets is they tend to cotton on to the potential for cuts earlier on. And so the markets were pricing in the cut from the US Fed before it actually happened. Therefore, our Treasury holdings went up quite a lot through the quarter. And when the actual interest rate cut came through, we saw that as an opportunity to reduce our exposure. So we halved one of our positions, which populates most of our portfolios. Again, doesn't populate the highest risk portfolios, but we decided to cut that in half and take profits on the strong move up. And that actually, now looking back, has been a very good thing to have done, because ever since then, the markets have maybe become a bit more realistic in the expectations of future interest rate cuts. And they have been steadily reducing their expectations through this year into next year. Therefore, that particular holding has given some of those gains back, but we halved it, so therefore we've taken less of that capital. So yeah, hopefully that gives a sort of overall a picture of what happened over the quarter.
Yeah, thank you, Mo. So it seems like there's a lot of kind of volatility more to be expected. The debate between hard and soft landing keeps going back and forth. So Mo, with a US election happening, with a lot of central banks looking to cut, wanting to cut, but maybe the market's optimistic, how would you see kind of the end of the year and Q4 unfolding?
Yeah, look, I think in terms of order, we may well see geopolitical tensions come through quite strongly in the next few weeks. The US election is started next month, so we may well see the geopolitical side coming through first and causing some volatility. Maybe just quickly mentioning our positioning around that, because that's something that we have been quite mindful of. We took the view that the chances were of increasing escalation in the region. So in the second quarter, we introduced some commodity-like exposures, particularly with a focus on energy, as a sort of hedge against an escalation. So as I'm sure many of you read, there was Iran attacking Israel more recently. That led to a very substantial rise in the oil price, going up about 13%. The holdings that we purchased for that reason appreciated in value, and therefore did act as the hedge that we were hoping they could act as. And then other parts of the portfolios also came through. So, for example, one of the reasons gold went up was for that reason. Another reason why the treasuries rallied, again, some of that was associated with geopolitics. And then in our core portfolios, one or two of our holdings that sit outside of the traditional equity and bond areas also appreciated in value. So actually, during that strike, the portfolios were either flat or positive actually through that time. So it was encouraging to see that the various things we brought into portfolios, with that being one of the reasons, it was a good test case, and actually we came out fairly positively. So yeah, it's geopolitics. Number two, I would say, yeah, clearly the US election, and at the moment, it's sort of 50-50, although I'll say very recent poll data suggesting that Trump is now pulling back ahead. He has been talking up a lot around the various tax hikes that he will implement and tariffs that he will implement on Chinese imports, for example. So as probably not unexpected, he has been, yeah, I suppose it's been Trump as usual. And let's see what happens, I suppose. We don't really know what the outcome is going to be and whether there'll be a clean sweep by the Republicans. So it'll be a wait and see, I suppose. But naturally, that could lead to some volatility as well. And then again, a lot of focus on the Bank of Japan, particularly with the potential for a new prime minister to come in. who has frictions with the Bank of Japan, and US data closely being monitored as well. So I think Q4 could be equally volatile, maybe more so.
And then just to touch on the point, I know you briefly mentioned how we have some China exposure, and then they had a large stimulus government spend in there. We saw the CSI 300 rally up about 30%, and it fell off a bit last week. How do you see the China story unfolding? There's some talk of them wanting to spend some more money on stimulus. It'd be great to hear your thoughts on that, Mo.
Yeah, look, I think from my perspective, I've seen a lot of managers, fund managers that is, who invest in that region recently. And one of them made a pretty good point, which was that in his view, the Chinese have probably decided to draw a line under the slowing economic growth that they've seen over the last 3 years, largely led by the property sector and the falling prices of property, which impacts the consumer, etc. So they are likely to have drawn a line under that and said enough's enough. We need to turn things around. That's why they came out with quite a material package that surprised many commentators. They had another meeting of the weekend where they didn't provide masses of detail, but they have provided more direction. And it looks like this could be a turning point, certainly from a fiscal perspective as well, which is probably more important. So we are monitoring very, very closely. My gut feel is that this probably has legs. It certainly won't go up in a straight line. And, as you saw last week, there was a bit of weakness when the Chinese didn't provide huge amounts of clarity in exactly what they were going to be doing and how much. So we've been monitoring closely, but if this does materialize as we expect, then we are likely to be adjusting our positioning to take advantage of that development, which I think could take, it could happen over several years. So potentially positive.
Great. Thank you, Mo. So that will kind of conclude our investment overview. So we'll now go on to the next topic of the agenda, which is VCTs. So for those of you that aren't aware of VCTs are a unique method of investing that Carrington offers. So essentially what happens is a VCT manager will pool investors' money together and invest it into small privately owned companies across the UK. This was created back in 1995 to try help boost small businesses in the UK economy. And they do this by creating tax incentives. So these tax incentives include a 30% income tax relief on investments up to 200k. But that's only once you hold them for 5 years. And then on top of that, you also get tax-free dividends and your capital gains also tax-free. So a VCT investment can really help small businesses grow, which is why they're quite crucial to the UK economy. And then some of the brands you might even know are VCT investments. So the non-alcoholic beer such as Lucky Saint, and then the fast food chain Five Guys are all VCT companies that sit within portfolios. So in order for VCs to raise new money, they implement offerings. So Al, it would be great if you could give an overview of the current VCT offerings that are taking place as it is currently VCT season.
Sure. Thanks, Lucas. So this year, some of the best performing VCTs over the last 5 and 10 years are back with offerings. If I start with the 3 that we've actually been following and advising people to invest in over the last nearly 10 years now, the first one that came to market is Mobius. And that's now a company VCT that's owned by Gresham House. They have very, very close to finishing their raise already, which was 60 million with an add-on of 30. So they've raised 90 million in the last 4 weeks, which shows you the popularity at the moment of the VCT investment. They hadn't raised money for a couple of years, so they felt that they wanted to come and do that this year. This offering will take them to around about £500 million VCT under management. If I just mention their record, so Lucas mentioned the upfront tax relief, and I'm not including that in some of the returns, but on a 5-year basis, they've been one of the highest annual returns of around 10%, but over 10 years, which I think are better numbers to use because that's more long-term and takes some of the sort of the volatility of shorter term out. They've been around 6.5% return. That return is coming through dividends. So they'll pay annual dividends. And again, as Lucas said, they're tax-free. So that's a terrific return on a gross basis when you're getting 6.5% or 6% through dividend yield. They've been around as a team together for over 10 years. No big change in them. They're a long-term, high-caliber investment team. And in the last year, they've sold just under 40 million of investments that cost 16 in the first place. So that's been a very good performer. But most people are going to have missed Mobius now. That will close probably the next 2 days. So the next one to come to market is British Smaller Companies. They're just a bit smaller, about 400 million under management in VCTs. Similar level of return over 5 years, similar over 10 years, and a similar profile over the last year, having sold between 40 and 50 million pounds worth of investments. And there's been a reasonable return there. So their long-term dividend yield is similar at 6%. And then after Christmas, we're going to get Albion Capital. And Albion are looking to raise 60 million. That will probably take them to closer to 700 million in total. And there again, over a 5-year return, it's lower. It's around about a 5% return. But 10-year is the highest of those three at 7%. So these three companies, and I'll go on to a couple of other thoughts on smaller VCT providers in a second. But just to say that those are very good 5 and 10-year numbers. What I would say is that during this period where interest rates have risen, and we're also post-COVID, and COVID drove up the valuation of private companies, whether it be VCT or private equity or EIS, we have seen a general fall in valuations over the last 2 to 3 years. And some of these three managers have offset that with some good sales at above the valuation that they were being held in their books. But overall, the industry has had a slight drop in overall valuation, which has led to, rather than the 10-year return being between 6 and 7%, it has been more like a 2 to 3% return. So definitely the last 2 or 3 years have been lower. However, what the industry is still doing is paying dividends. They're still finding investments. And importantly, for all three of these managers, they're now selling businesses again. And I think that's a sign that with perhaps the lower interest rate environment, that actually confidence is coming back. So just to mention, I mentioned some of the sales that the other two British Smaller Companies and Mobius made. Albion have made the largest one in the last quarter, where they sold Egress, which is an encrypted emailer company, which most people would have probably used at some stage. And they've sold that for over 60 million pounds, their particular stake, which was a multiple return on cost. And it does improve their numbers significantly in the last quarter. That's added 5% to their overall returns for the year. And they're looking to perhaps pay a special dividend of that 60 million out in the next quarter. So we're really pleased to see that those three companies that we've supported year after year are doing what they're saying on the tin. They're giving you a 5 to 6% return, and they're also selling some of the investments that they've got. So we're very pleased about those. And as I said, they're all doing raises between now and the end of the tax year. We've also looked at smaller companies or smaller VCT providers this year. We've kept an eye on them over the last 5 years, but they've not had 10-year track records yet. But they've got stable management. They're not as long-term as the other guys, but they are now north of 5 years with the same management in place. So we're very happy to suggest at the moment a Puma VCT, and as Lucas mentioned, one of their biggest investments is in Lucky Saint, the non-alcoholic beer company. And the second one is Foresight. Again, they've got very good short-term track records because they're smaller. They have made some sales early in their lives. And so they're, at the moment, very good 3 and 5 year returns. They're much smaller, so they're sort of around the 100 million mark. So very much so, you've got good management who've just started getting some decent results, but also you've got a smaller one. So I would say the one company that has in the VCT world that has really struggled the last 5 years has been Octopus Titan, because it's been the largest. It's over $1 billion under management, and I think they've really struggled to find really big returns now because of their size. Whereas if you go to a smaller one like a Puma and a Foresight, if they get it right, for instance with Lucky Saint, then it's going to have a more meaningful impact on the overall returns. And that's what they've done in the last 3 to 5. So we're very happy to entertain those. Puma are raising money at the moment. Because they're keen to build up assets under management, they're discounting their upfront fees more. So in fact, with Puma, you get a 2% discount to the normal 3%, and they're raising money at the moment. So we're really sort of keen on the 3 that we've always been very keen on, but very happy to start to entertain some of the smaller companies that are building up quickly. So that's the sort of the 5 VCTs that we're promoting. And then just a word, we've got a new government, clearly, and we've got a budget approaching. And just to say that for quite some time now, Rachel Reeves has talked to the VCT industry, and they are supporting investment, and VCT and EIS is very key to that. And they've come out and they've said they're very supportive of these structures. And so they've actually extended all of the reliefs for another 11 years, so that there's no doubt that this will still be a way to raise money for new companies. And interestingly, the 30% tax relief, and Lucas mentioned 1995 when it first came in, the last Labour government that came in, where Gordon Brown was the Chancellor, actually increased the tax relief to 40%. So it's not a foregone conclusion that they will actually start to reduce tax relief. At the moment, all of what they're telling us is that they're supportive of this. So I don't expect it to go back to 40, but at the same time, I'd be really surprised if we see a cut in the reliefs available, whether that be the capital gains tax, whether it be the tax-free dividends, or indeed the upfront tax relief. So yeah, I think it's a very supportive industry. We're looking for the whole industry to raise about 800 million again this year. And there's been a lot of work done between the VC industry and Treasury departments of the various governments to show the amount of employment that's been created, and then the tax that's being paid back to the Exchequer from that employment that's been created. And overall, I think it is going to be supported. So there we go. That's the sort of timetable that we've got on the screen. Mobius nearly finished. Puma is live now with its discounted upfront fees. British smaller companies will start again later this month. Foresight closely after that, and then Albion will come in the new year before and look to fill it, in the first 2 months of last year. So yeah, thank you for involving me in today's webinar, and any questions, happy to take them.
Sure. Al, I have a question for you. So with a lot of speculation on how VCTs are going to change in terms of tax relief purposes, with the budget at the end of the month, how would you suggest clients to include VCTs within their portfolio? What would you see as the best way?
Well, if they're very quick, Mobius, the first registration date for the shares that you can buy today is going to be pre-budget. So again, with most things around the budget, if you can get things done and registered and shares being issued, if you can do it before the budget date, that's probably the best way to guarantee the current rates. But as I said, I'm going to be slightly optimistic here and suggest that there won't be too many changes beyond the budget. So I wouldn't make that your be-all and end-all decision. But if you really wanted clarity, I believe Mobius and I believe also Puma are also doing a first registration of new shares prior to the budget. So that would be the guarantee. But overall, I'm more relaxed about this than other parts of the savings industry and what the Chancellor might do.
Okay, thank you. And then I've got a question for Mo here that's been put through. So regarding gold, we've seen a lot of major central banks buying up gold to kind of stay away from the dollar. How do you see that playing a part in the price of gold? And then also on top of that, with geopolitical tensions, how do you see kind of all those factors playing into the gold price?
I think for gold and the central banks, they've been integral or critical to its appreciation in the last 18 months or so, maybe even longer. So if we think about, let's say, earlier this year and even back end of last year, the gold price just kept appreciating, and a lot of commentators were slightly confused as to why that was happening when the environment was such that maybe gold shouldn't have appreciated in value. And we saw a lot of investors in things like funds and ETFs that hold gold. They were generally selling, especially last year. So there's a lot of sort of global sales that, in theory, should have put pressure on gold and other related assets. But the gold prices kept going up now, and that's largely been attributed to very significant levels of buying by the Chinese in particular, but other central banks like India and Brazil. So yeah, the main theme is that they are actively, and Russia by the way, so they've been actively trying to diversify their reserves away from the US dollar. And that was the start of that process was when Trump was in power last time. And he was sort of weaponizing the SWIFT payment system. But the second one was really the Russian invasion of Ukraine. So once the Americans had seized their assets, a lot of governments in the sort of emerging world saw that as a threat, as a risk to them. And so there's been a very sort of concerted effort to increase their gold reserves at the expense of the dollar. It's quite hard to sort of put a number on it, but as far as I'm aware, that has increased to about 9% in aggregate. And there are some suggestions that their ambition is to get that to at least 20% in the next couple of years. So I believe the Chinese are paused at the moment, but I wouldn't be surprised if that continues or starts again and continues in the next couple of years. So there's certainly a lot of support around foreign government buying. And then on the geopolitical side, yeah, clearly, gold as well as other asset classes are seen as safe havens. So if there was a big escalation, then it's very likely that will appreciate in value. Maybe just one other last quick point on that is a lot of those sales that happened in the last 18 months or 2 years from investors, which I believe amounted to about 15% of total assets held within gold-related investments, they haven't really come back yet. So that again is a potential tailwind that whenever, and the thought was that maybe they will start to come back once interest rates begin to come down in the US. So there's a potential tailwind from investors reallocating back to gold and other assets.
That's great. Thank you, Mo. So all things good for gold, it looks like at the moment. Just got one more question for you, Al. So for people currently on the fence about VCTs, what would you say to someone of why VCTs are the right fit?
Well, I think the first thing I would say is it really depends on the overall umbrella of investments that an individual has. So I would definitely say this is still a conversation to be had on an individual basis. This is not a fits all investment. But saying that, a lot of clients that we know are trying their best to do as much pension contributions as possible, ISA contributions. Pension contributions they might be limited on, and ISAs are still a very small amount that you could put in every year. So I think if you're in the luxury situation of having done those two things in terms of contributions, then I think people should then look at VCTs. If they've got an exposure to private company investments already, then I would then say, okay, let's just look at the overall balance between liquid investments, and that mostly listed, and some of those illiquid. As I say, it's still very much dependent on people's situation, but I think if you're looking for the best tax relief post what pensions can offer and ISAs, then there's still a place for this. And I would say that although you have to hold them for 5 years to get the tax reliefs, we're seeing more and more people holding these during retirement because they get used to the constant dividends that are paid out, and those dividends, when you're filling in your tax return, you don't have to worry about it because they're tax free and you don't have to declare them there. So yes, depends on people's situations, but we're seeing people now very comfortably holding them for longer rather than a shorter period.
Okay, yeah, thank you. So that will conclude the Q3 webinar. Thank you, Mo. Thank you, Al. And thank you, everyone else, for joining. I hope you found it insightful. And if you have any follow-up questions or any other questions, please feel free to email us. Hope you will have a good rest of the day. Thank you all very much.
Thank you very much.
Thank you.